Hello and welcome to Bondcast, a podcast series where we discuss our views on the latest themes and events shaping rates markets. I'm Imogen Bachra and I'm joined today by our global market specialists, Oriane Parmentier and Ian Vanderhorn. This is the first episode, it's the first episode of Bondcast I've recorded for a long time, but it's certainly the first episode that we've recorded since the conflict in the Middle East began just a couple of weeks ago. It feels like a lot has happened since then, so there's a lot to catch up on. And I think, Ian, it probably makes most sense to start with you this week. Do you want to just give a broad kind of update on, your outlook from here, how this has changed or not changed your views, how you're thinking about oil here and what that means for your Treasury outlook?
Yeah, absolutely. Glad to. And thank you, Imogen. I think you hit the nail on the head with the focus on oil because the context of the conflict, that's well known and it's been well covered by the team. But I think oil price remains the focus for markets. And just we've seen how volatile oil has been. We saw crude soar to prices as high as $120 per barrel early on Monday, fell back sharply to around $80 per barrel, and now we're trading in a wide but volatile band around the $80 to $90 per barrel mark. So cross-market assets really have been trading off the price moves around oil and the expected duration of the conflict and thus the supply shock to oil and the impact to the price. The problem continues to be that the endpoint remains really unclear with respect to this conflict. The Strait of Hormuz remains effectively closed. We have Gulf countries shutting in their production simply because there's nowhere to put the oil. There are some offsets to this. We saw today that there's pipeline through Saudi Arabia and the UAE. They're diverting some of the trapped oil through those pipelines to be shipped out of other locations. But other countries are effectively still completely trapped. I think of Iraq when I say that, which has shut in as much as 3 million barrels per day in production. The other offset we've seen recently, I'll speak to the one we saw today, is that we saw the IEA announce that they'd be releasing reserves of as much as 400 billion barrels of oil. 80 billion of that is coming from Japan specifically. That's a really significant release. It's more than double what was released at the outset or at the onset of the Russia conflict. But if we think about it in the context of global demand for oil of about 100 billion barrels today, it really probably offsets only about a month of lost flows coming through the Strait. That being said, it's probably the only reason oil is trading where it is and not at $100 per barrel. It's really not a long-term solution for markets. And I'd also just point out that derivative products are trading much higher. I think about jet fuel, I think about diesel. And the reason is because regardless of what's going to be released from these reserves, there's still uncertainty about how much oil is going to hit global refineries around the world. So they're already cutting back their production in anticipation of less crude oil input in the future. So derivative products are sharply higher in price. We're seeing that here in the U.S., of course, with respect to gasoline prices at the pump. Another thing that we have seen a bit of a development in the last few days is that Trump has been much more sensitive, in our view, to these higher prices of crude oil and accordingly derivative products. We've seen him use what I would sort of call a little bit of verbal intervention in the last few days. He's gone to reporters and said that the end of the conflict could be soon. That's probably just in response to how high energy has risen. But there's a problem with this in that, you can't really, to use market parlance, taco out of this one. You can't really back away from this conflict as easily as you could with, say, some of the tariff threats that we saw last year. So Trump again today, this morning, said that this conflict would end soon, and markets, hardly reacted. So I think they're already growing a little bit wary of that type of verbal intervention. But yeah, the market reaction, it'll continue to be dictated by the expected duration of this conflict, the expected duration of elevated energy prices. And like I said, there's really just no way to know what Trump will declare as a victory and when this whole thing will wind down. I think that markets are coming to terms with a little bit of a longer conflict, despite what Trump said, as I mentioned. But yeah, it just doesn't look, at least in our eyes, to be that easy to back away from. So I'm going to pull this back into treasuries real quick because if we think about the reaction in rates that we've seen over the last week and a half, I think they really come from three concurrent market shocks. Two of those are related to energy. So the first shock would be the upward pressure from oil and gas on inflation. That one is well known. The second would be the downward pressure of elevated energy prices on growth. Higher input prices lower production, higher prices for consumers lower the overall basket of consumption. So those are also fairly well known. I think the third is being, I guess, less focused on right now, and that's the fiscal shock to government spending. Wars are expensive, bombs are expensive, and there's probably going to need to be a supplemental spending bill coming out of Congress in the near term. Not quite sure if it has bipartisan support currently, but it will need to gain that support eventually. So the market reaction in rates reflects, a balance of those three shocks that I mentioned. We have front-end rates higher on the inflation outlook, the expectation for potentially less Fed, and then the longer end is higher, of course, less so, driven by that very long-term inflation expectation and the expectation for additional fiscal spending. But the focus for traders, at least initially, has been on the inflation side. Hasn't really been the case, I'd say, over the last couple of days. We've seen a little bit of bear steepening on the Treasury curve today and yesterday. So I think we're starting to see a little bit of pass through into expectations that this could be a longer conflict, that inflation could run a little bit hotter for longer than expected. And if we just look at longer term break evens, those are starting to trade a little bit higher, sort of in line with front end breaks. And as I mentioned, the Treasury curve is bear steepening a little bit here over the last 2 days.
I think it's really timely, well, you might argue timely or not, then, that we are recording this today on Wednesday, and we're obviously staring down a week ahead of, all three major central banks meeting next week. We have the Fed, we have the ECB, and the BOE, who will all be making rate decisions against this very uncertain backdrop when it comes to the inflation outlook. The market has clearly made its mind up to a certain degree, as you said, around what the kind of primary impact of the conflict is going to be on inflation and what that might require in terms of central bank response. What does this mean for the Fed's reaction function, both in the near term, but perhaps taking a slightly longer view as well?
Yeah, well, I think you hit on one of the really important points, which is that the Fed does have a dual mandate. It has a mandate for inflation, and it has a mandate for full employment, i.e. growth, whereas, the BOE and the ECB are inflation targeting central banks. So I hesitate to say this, but just because of the Fed's dual mandate, it doesn't really change our reaction function or expected reaction function, I would say, for the Fed really all that much. As I mentioned, and then you reiterated, markets have really been focused on pricing in less Fed on the inflation side. But we're not necessarily sold that that's the correct view over the medium to long term, because there are growth impacts. And we think that the Fed will actually want to focus on these growth impacts, potentially to a level that would speak to more easing. The inflation impact from an energy shock, it tends to happen in the early innings, in the early quarters. The growth impact tends to happen over a longer period, and it actually tends to be a little bit more durable. So we do expect that the Fed will view the impact to inflation from oil as being more, I'll use the word transitory just because that's the word that they continue to use when it comes to something like tariffs. And the impact to growth a little bit less so. It's worth noting that we heard from Fed Governor Moran last week, he sort of reiterated this point. He said that an oil shock actually skews him towards the Fed needing to do more, i.e. lower rates further. Governor Waller, I wouldn't say he was as overt in saying that, but he sort of, alluded to the same. So we know these views are being circulated among Fed members. Granted, those are two of the leading doves on the committee, but these are valid points if you're a dual mandate focused central bank. And then I sort of mentioned earlier that if we think about cutting rates to address the growth side, we also have to consider what that could mean for longer term inflation in addition to just shorter term inflation. And then if we layer in the potential fiscal pressure that could come from needing to actually fund this war, it's a bit of a risky scenario. It's a no-win scenario for the Fed, really. So we haven't really backed off our rate expectations for the Fed. We're still looking for 75 basis points of easing in 2026. We did, I'd say, tweak our Fed call. We were looking for 50 basis points of those cuts to come at the June meeting. We're now looking for just 25 basis points in June, another 25 basis points in July, and the final 25 basis points in September. But really not significant changes. We think the Fed is going to favor growth, and we think that they're going to do so regardless of inflation at or around 3%, which could persist, for the foreseeable future. And then just on the curve, we think that speaks to a steeper rate curve, as we've been saying for many, many months. So not hugely changed in terms of Fed outlook.
Thank you, Ian. I think even if the view isn't changed, it's really useful to kind of run through your thoughts here. Obviously, markets have been very volatile, so it's always good to kind of take stock and get an update of where you're at. Let's turn over to Europe then, Oriane, because of course Europe hasn't been isolated from these market moves either. So I guess it's similar to how I posed the initial question to Ian. Do you want to just give an update on your latest views, given everything we've learned over the last couple of weeks and the way that the market has moved?
I think the kind of big question for Euro market as well is how the ECB is going to navigate the kind of current geopolitical uncertainty and the spike in energy prices. I would say that in terms of our expectation, at least in the short term for next week's ECB meeting, we think that they will stay in this watchful waiting mode for now, and they will want to see a clear impact on inflation expectations before making any moves. But I would say beyond that, even we continue to expect a no policy change for this year for the ECB. I think if the conflict turns out to be an energy driven and mostly transitory shock, then the ECB will likely want to look through it. And in that sense, I think perhaps, the kind of repricing from markets on the front end of the curves, seeing an increased probability of rate hikes for this year maybe could end up being a fade, I would say. I think it's also interesting to look at inflation expectation, in particular medium-term inflation expectation. So, for instance, the five-year inflation swap in Europe is still around 2.15%, which is essentially just above the levels it's been for the sort of past 10 months. So still quite, relatively anchored inflation expectation for the medium terms at least. As Ian was mentioning, clearly the biggest uncertainty is simply how long this conflict will last. And I think, the persistence of the inflation shock clearly will matter for medium-term inflation expectation, which really is what the ECB cares about. I think one interesting point is that on energy, policymakers, notably in Europe or including in Europe, are clearly trying to avoid a repeat of 2022. We think for a number of reasons that we're not there, but I think still interesting to see how For instance, G7 finance ministers have been floating ideas to keep oil prices in check, potentially from possible reserve releases and even ideas on the side of Trump of potentially even easing Russian oil sanctions. So none of this is guaranteed, of course, but I think it shows that leaders are actively trying to keep a lead on energy pressures. But in the near term, I think markets will remain driven by this risk-on, risk-off swings. Clearly all about whether the conflict remains short-lived or risks escalating. But I would say that despite this noise, our strategic views on the European, on European rates still leans towards higher rates later this year. I think if the conflict drags and turns into, a broader regional war, for instance, the risks clearly get bigger. I think it would likely trigger a significant risk-off move, but the direction of ECB policy in under that scenario, I think, also becomes less clear. Markets might price more inflation persistence, but I think the balance between an inflation shock and a growth shock also would get harder to read. And I would say in an even more severe scenario, so think something closer to 2022, for instance, where inflation skyrockets and growth turns negative, I think the ECB could even be pushed into hiking even during a recession, and would even potentially have to dust off tools like the TPI. For now, we continue to see that as a tail scenario, but one that can't be fully dismissed either, I would say. And a final point I wanted to make is on sovereign spreads. We are strategically constructive, but I think in the near term makes sense to still be cautious.
Yeah, I think it's notable the extent to which sovereign spreads have remained relatively well contained despite the volatility that we're seeing in other asset classes. Just before we switch over to the UK then, away from the sort of implications of the conflict, it's of course feels like it's not forefront of everyone's minds this week, but there is the local elections in France at the weekend. Can you just talk us through very briefly your thoughts around what this might mean for rates in France?
Yeah, so I was always of the view that this local election in France wasn't going to be especially market moving, to be fair. But I think given the current geopolitical context, it's even more true probably. Just a few points still. I think there is little political risk premium for me priced in in OATs at the moment, and rightly so if we see it through the lens of the local election. Local elections in France tend to have limited scope, and I think they're not a straightforward kind of mechanical test for the presidential election. And I think from a market perspective, the impact should remain moderate. I think even if the far-right party, so the National Rally, performs strongly, the effect would, in my mind, be limited because they are leading in national opinion polls for the presidential election anyway. And if anything, I would just mention a surprise victory by, say, multiple left-wing candidates, especially from the far left, could perhaps have a more noticeable market impact. But I think the recent news flows in France, if anything, really doesn't advocate for that. So I would expect limited market reaction to the first round of election after this weekend. But turning to the UK now, you mentioned we have the BOE next week. Can you please perhaps give us your take on this and more generally on gilts?
Yeah, I guess taking a step back and thinking a bit more generally on gilts first. I mean, regular listeners of the pod will know that we've always had quite a bearish view on gilts. So we've always felt like yields should be higher than they were trading in the first part of this year. Of course, a lot of that was predicated on domestic political risk. And we kind of, if you looked at our profile, we had the peak in our gilt yield forecast around the middle of the year, which of course coincides with when we felt like those domestic political risks would be strongest around the time of the local elections in the UK. But we've reached those kind of higher yield levels sooner than we expected. Of course, it wasn't, for us, it wasn't about war in the Middle East or oil reaching the kind of high levels that it has. But I think that the events of the last week or so, last couple of weeks, have probably reinforced or at least exposed, these challenges facing the gilt market. And whilst it doesn't require us to necessarily move our targets in terms of where we expect those yield levels to get to, I think it does add an element of upside risk and more confidence that we are in this kind of higher for longer yield backdrop. And really, what I mean by that is there's three things I would highlight for the UK market that I think have been reinforced over the last week or so. The first is just that the BOE is in a much more difficult position than other central banks. You've talked about the ECB probably not needing to react in the near term. We've talked about the Fed not needing to tie their hands in the near term. And we can come on to what we expect from the BOE next week. And it's not that I expect them to say anything interesting next week or even tie their hands to the mast. But the BOE is approaching this new energy price shock with very different baggage to the ECB, for example. We are 4 years on now from Russia's invasion of Ukraine and the energy price shock of 2022, and service price inflation in the UK is still above 4%. So it has stickier inflation dynamics than the ECB, for example, and it can't lean on its dual mandate like the Fed can, for example. In theory, we should be caring more in the UK, the policymakers should be caring more about this still very sticky inflation backdrop, which of course is only worsened in the near term by the conflict in the Middle East than its peers. The second point is that the fiscal dynamics remain very concerning. And to Ian's point earlier, he was talking about the fact that, even if we get slightly more favorable from a market's perspective headlines around the conflict being over, we've had Trump on the wires twice now this week talking about the conflict being near an end because the US and Israel have almost destroyed the Iranian defense capabilities. And the market reacted very strongly to the first set of those headlines and has pretty much shrugged off that set of headlines today. But that isn't just about, whether the market believes that what Trump is saying. I think that's partly that it's very difficult for a lot of the impact of the last couple of weeks to just be shrugged off so easily. It's not the same as reversing tariffs in terms of a market and economic impact. The inflation shock, the energy price shock has already happened. The disruption to supply chains has already occurred. But also from a fiscal perspective, a rapid end to the conflict sooner than we're expecting does not reverse the need that there is now going to be greater pressure on governments everywhere to increase and accelerate fiscal spending on defence. And regular listeners will know that we've long been concerned about the fiscal backdrop in the UK, and as a country it's going to be very difficult for the UK to fund any increased defence spending with extra borrowing. We are really up against those fiscal limits, and so the only way that will be able to occur is through higher taxes, which is obviously going to be difficult for this government to deliver. And the final point, which I think is also really important, and this is kind of a new feature, I would say, of the gilt market over the last couple of years, it's sort of a post-2022 legacy, if you like, is that gilts have tended to underperform global rates in a sell-off. If you look at the relationship between treasury yields and the spread between gilts and treasuries over the last 10 years, for example, what you'll see pre-COVID, pre-2020, is that higher treasury yields tended to correlate with a lower gilt treasury spread. That is, in a rising rate environment, treasuries are leading the way and underperforming gilts. What we've seen since 2020 is a major reversal of that trend. So in a higher treasury yield environment, gilts are underperforming, i.e. gilts are leading the way higher. And so that is, that is telling us that investors generally are demanding a higher risk premium to hold gilts. And it becomes a bit of a vicious circle, because the more that they underperform in these kind of risk events, the higher that premium becomes, and so on and so on. And the problem for gilts here is, it's a sort of lose-lose situation in my view, because we had this higher yield target predicated on local, domestic political risks. And so even if the sort of global risks subside, domestic risks just come back to the fore, and those political pressures on Keir Starmer and his government return. So I'm not inclined to change our sort of bearish view on gilt outlook. We had a 4.8% target for 10-year gilts, which we sort of fleetingly met on Monday, and have since rallied back down again, although we're selling off again today. So we're not that far away from 4.8. It doesn't feel like a big call from here. But I guess my view is that this is a kind of sustained increase in the equilibrium level of gilt yields, rather than a temporary blip off the back of global risk events. For what it's worth, our sort of fair value model for 10-year gilts points to yields actually slightly lower than 4.8, probably closer to where we are now. But there's a couple of reasons why I think I would be happy to kind of override the output of that fair value model. The first is that it doesn't really capture perfectly the fiscal regime shift. We're in a very different fiscal backdrop now than we were even just 5 years ago. And it's not just about the net supply outlook that I'm talking about there, but the influence that the politics has on the market, the influence that, things like the gilt remit, the OBR, etc., and all of the upside risks that the expansionary fiscal backdrop that we've been in for the last couple of years implies for the inflation outlook as well. The model doesn't capture perfectly the shift in the demand side in the UK. So we've obviously had this big shift over the last couple of years away from, long dated price insensitive buyers to much more price sensitive buyers. And of course, overseas investors are the marginal buyer of gilts, which is why we see this kind of sensitivity to global risk events. The model doesn't capture that sensitivity to global risk events well. It's a sort of domestic fundamental factor model. So it doesn't necessarily capture what, influences from outside of the UK. But importantly, thinking about that premium that gilts demand and how this is a sort of regime shift for the gilt market, the model also doesn't capture the fact that gilts are increasingly, not necessarily being priced on fundamentals. And I think a good way of looking at that or thinking about that is that if you look at Bloomberg consensus forecasts for growth and for inflation, for example, over the next year, over the next 18 months, if we look at how those have trended in the UK over the past 12 months, they've actually barely moved. It's been fairly unexciting from an economic standpoint. They're broadly where they were just 12 months ago. But if you look at Bloomberg consensus for 10-year gilt yield forecasts, for example, they have increased relatively significantly, in the region of 50 basis points. And this is all pre-conflict, I should add. And so increasingly, this kind of premium, this post-2022 premium, is becoming a permanent feature of the gilt market. And so I'm inclined to think that the kind of upshift that we've had in yields, whilst we didn't, of course, have it down to, we didn't have it in our forecast because we saw this conflict coming, but I think that we are at levels that are more justified based on the UK backdrop in longer dated gilt yields. The front end's a little bit different. I mean, the market has moved a long way from pricing in a rate cut in March with near certainty to now actually thinking that, with very little confidence, but some possibility that we could start to think about rate hikes towards the end of this year. And I think that probably that reflects a potentially more realistic outlook than we had just a couple of weeks ago when the market was pricing a rate cut in March with near certainty. We were never quite sold on that being the outcome. We do still, however, have a rate cut, one last rate cut in our profile currently. We see that more likely being in April. But I think it's fair to say that we are waiting to see what the BOE tell us next week, but I wouldn't be surprised if we, once we're chatting next week, we kind of take that out of our forecast and actually just see rates remaining here at 3.75% for the rest of the year with, like I say, some plausible possibility that we're talking about rate hikes by the end of this year. Just thinking about the BOE next week, I think similarly to the ECB and the Fed, we aren't going to learn all that much new from them. Unlike the ECB and the Fed, it's not a forecast round for the BOE. So, a more timely moment for them to formally update their projections would be at the April meeting where we get a whole new set of forecasts and they can refresh their guidance then. But I think that they will be unlikely to offer very much in the way of updated guidance, just given the uncertain backdrop. But I do think that it means that a March cut is off the table, and probably with a fairly convincing vote. It could be 9-0 with the guidance, letting us know that they will reconsider and refresh their projections over the coming weeks once we have more clarity on the backdrop. But I do think generally this is a more difficult situation for the BOE to tackle than for other central banks. And I think markets are right to have repriced that reaction function. We've probably gone a little bit too far now. I would say front end yields, if we look at 2 year today, it's sort of 390. I would have put fair value for that closer to 380. But I think the rate path that is being implied by the market is perhaps more realistic now than we were just a couple of weeks ago. I will stop there. I think that's probably all that we have time for today. But just a reminder to our listeners, if you like what you heard, please subscribe to our channel and don't forget to hit the like button if you can. Thanks. See you next week.